And I will be hosting today's CPD session brought to you by the Network of Consulting Actuaries. The Network of Consulting Actuaries is an independent organisation comprising of UK actuaries committed to developing and sharing knowledge amongst our colleagues. Our vision is to make a positive contribution to the ongoing development of the financial sector. Today's session is titled Dynamic Discount Rates Consideration for Scheme Funding and is presented by members of the IFOA Working Party on dynamic discount rates. The members of the presenters today, who are all members of this working party, are Gareth Connolly. Gareth has worked predominantly in the pensions consulting sector and is chair of the working party. He's a senior director and scheme actuary at Willis Towers Watson. Phil Hardingham has a background in investment consulting and has more recently focused on integrating modelling and digital capabilities into advisory services within the pensions market for Hyman Robertson. Kenny McIver began his career as a life insurance consultant at WTW with a focus on bulk purchase annuity market. He is head of trading in the retirement solutions segment of Phoenix Group. And Luke Stratford-Hyton has a background in both life and pension sector, with experience mainly focused on pensions risk transfer pricing. He is an actuary at Clara Pensions, a DB pension super fund. One thing to say is that the presenters are giving this presentation in their own capacity. The views are not necessarily those of their employers or the Network of Consulting Actuaries or the Institute and Faculty of Actuaries. The slides are available on our website, www.noca.uk. And this could count up to 1 hour of your CPD requirement. So with that, I'll hand over to our presenters to start the presentation.
Great. Thank you very much, James, and thank you very much for the invite to speak today. So welcome all. Move on to the first. So background to the formation of the working party. Now, the catalyst for forming this working party was a recommendation in a 2021 Target End States Working Party report, which I've summarised there on the top left of the slide. I'll give you a moment to read it. So you'll notice in there that there's the wording dynamic discount rate. So this was the first time that I'd seen the phrase. And if you read that report, it sets out in some detail the benefits that such an approach could bring to scheme funding. So whilst the phrase was new, the potential for artificial volatility in funding that some funding approaches could introduce was not. And as a scheme actuary, that was a particular concern of mine. This is especially relevant nowadays in light of schemes being generally better funded. So for instance, with my clients at least, the trustees and sponsors seem to be more relaxed, or they seem to be more relaxed about funding fluctuations when the funding level was around, say, 80% than when it's around 100%. To put this volatility in context, the chart on the slide is taken from our report and illustrates the issue of volatility on funding level for a sample scheme invested in corporate bonds and using market data over the last 30 years. So the chart has 3 lines. You'll see there's a blue dotted line, which shows the credit spread of the portfolio with an inverted scale on the right-hand axis. There are 2 other lines, a grey and a black line. The grey line shows a funding approach, which is based on gilts plus a fixed margin. The black line shows a funding approach where it's based on a proportion of the credit spread, but subject to a maximum value. Further details are in the paper, but as you can see, one certainly has a lot less volatility than the other, particularly around the time of the credit crunch in 2008. So with the recommendation from the other working party in mind, a request for volunteers went out in early 2022, feels like a long time ago now, and a working party of 7 was established. Now, I think it's fair to say that since the start of 2022, there have been a lot of developments affecting pension schemes. So in no particular order, we've got the LDI liquidity crisis, general improvements in funding levels, the pensions regulator's consultation on the new funding code, and the Mansion House proposals. We've included commentary on the implications of all but the Mansion House proposals, as our report was largely written before July 2023. If I move on. So I won't spend long on this slide, but the intention of it is to highlight the different backgrounds and skill sets that the volunteers brought to the working party. So you see we've got a team of 7. We've all got, we all claim we have expertise in liabilities. The expertise in the other areas is clearly variable. Now, the working party members were chosen specifically so we had experience in a wide range of areas, and we thought that was useful. And it was useful when we produced the paper because we found the topic of dynamic discount rates is one that's best considered from several angles. And that's the theme also brought out in that target end states working party paper. Moving on. So the first task of the working party was to agree our objectives, and these are summarised on the diagram. And each is covered in detail in our report. So we've got, starting in the middle, we've got defining what we mean by dynamic discount rate and review of current practice, stakeholder considerations, when is it beneficial, what can, particularly the pension scheme actuaries such as myself, what can we learn from insurers? The bit that Luke will talk quite a bit about is what does it look like in practice, implications for other areas, and the bit that Phil will talk about in particular is new skills and next steps. So starting with the big block in the middle, what do we mean by dynamic discount rate? So we came up with the definition on the top right of the page. Again, I will pause for a moment to let you read it. Now, if you read it and take a step back, you might be thinking, well, this isn't new. If, for instance, you've been using an asset model to set the discount rate. However, what we are focusing on in our paper is schemes that have a matching investment strategy where there's a large degree of contractual asset cash flows in the portfolio, such as corporate credit, that are similar in nature to the pension scheme cash flows. So that's the difference, really. We're looking at dynamic discount rates for that subset of schemes, although we acknowledge the concept of dynamic discount rate could be applied more widely. In terms of an overview on current practice, we show on the next slide a summary of typical approaches to funding. We have had to rely on anecdotal evidence from individual firms as there is a distinct lack of external data, and this leads to one of the recommendations we make. More on that later. Given time constraints today, we will focus on the boxes coloured in gold. So we've already defined dynamic discount rate in terms of current practice. Now, 2 things to note here. There are a lot of words on the slide. I'll let you read it after the event if you so wish. The other one is I'm conscious if there are any pensions actuaries out there, there's an element of me teaching Granny to suck eggs for the next 5 minutes, so please forgive me. I'll summarise the key points on this slide. So the slide sets out what we see as being the 3 main approaches used to setting discount rates for funding purposes. So we've got on the left-hand side, gilts plus a fixed margin. In the middle, gilts plus a variable margin. And the one we're particularly interested in, and what our paper focuses on, is the dynamic discount rate. So as we move from left to right, we could say that the frequency of change in the discount rate increases. Also, the link between the discount rate and the assets held actually strengthens as you go from left to right. The first 2 approaches start with gilt yields and then apply a margin that is either fixed over time or reviewed periodically. Now, in reality, a lot of schemes that use the first approach, the fixed margin, will review the margin as time goes on and as investment strategies change. So it's probably more accurate to think of these approaches, well, all 3 as being on a spectrum. There are not 3 discrete approaches. You can regard approaches as being somewhere along this range. Now, the dynamic discount rate can be thought of as a refinement to the variable approach in that the margin changes far more frequently. Another difference which we introduced in our paper is how that margin for prudence is expressed. More on this later from Luke. It can also be thought of as an approach that doesn't necessarily start with gilt yields as a building block, but in practice, the discount rate might be parameterized as being gilts plus something, plus a variable. For ongoing monitoring purposes until such time as the discount rate is formally reassessed. Now, we'll next look at the changing regulatory landscape in order to understand how this dynamic discount rate approach fits in. So these slides are actually provided by Andrew from the pensions regulator. He's given me his notes, so I will try to do them justice as someone who doesn't work at the regulator. So in 2018, the government announced a package of measures to focus trustees' long-term thinking and approach to risk management, to encourage greater accountability and transparency, and to support a more effective and efficient DB regulation. So the key elements to this package are as set out here. There's legislation, in particular, the Pension Schemes Act 2021 and the Funding Investment Strategy Regulations, which came into force on 6th of April. The legislation provides 4 key principles for trustees, and these are to aim for low dependency on the employer by the time the scheme has reached its point of significant maturity. Number 2, to put in place a journey plan towards that point. Number 3, to take supportable risk along that journey based on the strength of the employer covenant. And number 4, to agree deficit contributions based on reasonable affordability. Then there's the Regulators Code, which sets out their expectations for trustees on how to comply with these requirements. Now, the original text for this slide said that the code will apply to all valuations with effective dates from 22nd September onwards. However, as you'll have noticed, there is a general election underway, and that's throwing the timetable for the release of the funding code into some doubt. I'm sure it will come into play at some point, but we just don't know yet when. And finally, supporting the code is the twin track regulatory approach to valuation submission, bespoke and fast track. More on this in a moment. Now, in terms of the new funding and investment regulations, they introduced 2 new requirements. So you've got at the top, you've got to achieve low dependency funding using a set of assumptions consistent with the low dependency investment allocation by a relevant date, no later than significant maturity. For those of you who work in pensions, hopefully you're familiar with all those terms. For those who aren't, they're all defined either in the regulations or will be in the Regulators Code. The second point there is the technical provisions must be set consistently with low dependency by the relevant date and with a journey plan to get there. So when thinking about the new requirements or how they apply, it's helpful to think about mature and immature schemes. So the regulator expects many mature schemes that want to achieve low dependency on the employer will be attracted to cash flow match strategies, which lend themselves to a DDR approach. One of the benefits of the DDR approach is that it will limit the volatility in schemes funding and hence the need for additional funding from the employer. The draft code, which was consulted on late 2022, highlighted that dynamic discount rates could be used in a low dependency funding basis where schemes have invested in a way to match their liabilities. So that phrase was specifically included, which is probably something to do with Andrew being on our working party. Now, for more mature schemes, there is scope to invest in a wider range of assets that take more risk, if that risk is supportable. So in theory, there's nothing in the legislation or draft DB code that restricts the use of dynamic discount rates for immature schemes. Schemes could adopt a cash flow matching strategy if they can find suitable long-term investments to match payments far into the future. In practice, and in reality, I expect most schemes are likely to partially cash flow match in this situation, which could mean they use dynamic discount rates that are partially dynamic. So, for instance, the dynamic discount rate could relate to the assets backing the liabilities where there is a good overlap. And for the other bit, they could use a discount rate based on other asset returns or growth assets. So it's important to note that on this slide, in chapter 2 of our report, we do go into some detail of other approaches, other examples of approaches to set dynamic discount rates. And some of those do include growth assets. So it's not all about taking lots of risk out of pension schemes. This is about finding assets that match liabilities to the extent you can. And if you want growth assets in there and you can afford the risk of them, then that also fits in with this framework. The final one from me on slide 9. So another key aspect of the funding regime, as I mentioned before, is this twin track assessment to demonstrating compliance. We've got fast track and we've got bespoke. So fast track represents the regulator's tolerated level of risk. Schemes can compare themselves to a series of measures and parameters, and if they meet all those measures and parameters, they can use fast track. Alternatively, schemes can go down the bespoke approach, where they have greater flexibility to adopt a strategy that reflects the characteristics of their scheme and the covenants offered by their employer. Trustees that take this approach will be expected to provide evidence as to why their long-term strategy is appropriate and they can support the risk being taken. And that will be set out in, again, new jargon for pension schemes, a statement of strategy. Now, the key point here is the way the fast track parameters have been set, it's based on, for the discount rate, on gilt plus a fixed margin for both the low dependency and the technical provisions. So a dynamic discount rate approach where the margin over a risk-free rate, if that's how it's expressed, is likely to vary in different market conditions and indeed should vary in different market conditions. So it may not necessarily fit nicely and easily into the fast track approach. However, it doesn't mean that a valuation couldn't satisfy the fast track assumptions at a valuation date. So the regulator thinks that the scheme using a dynamic discount rate approach is more likely to go down the bespoke route. And trustees of those schemes can explain in a statement of strategy how that margin over the risk-free rate has been determined at the valuation date and how they expect it to vary. So in summary, wrapping up my part, my expectation is that the dynamic discount rate will be of greatest relevance to the mature schemes who will need to go down the bespoke approach. It's not saying it's not relevant for other schemes, it's just most relevant for the mature schemes. Now, I'll hand over to Phil now, who will cover the topic of dynamic discount rates and stakeholder considerations.
Great. Thanks, Gareth, for laying some of that groundwork of the regulatory environment. And what I'd like to do here really is to step back and ask the good question, well, for the regulator and for the industry more broadly, what are the potential benefits from a dynamic discount rate framework? And also, who are the people that will benefit from it? And we should do that in tandem whilst thinking about potential drawbacks or risks that we want to navigate when designing this type of approach too. So let's focus on sponsors and trustees first off. Why is it that they might be interested in this type of approach and exploring it? And from their perspective, there's two particular themes that I'd like to draw out. The first theme is stability and predictability. So by design, this approach creates a much closer link between assets and funding liabilities. And as a result, we'd expect to see fewer fluctuations in the funding level over time, which is attractive to trustees and sponsors. And to build on that, where we do see a fall in the funding level, we'd expect this to be a much more explicit signal that there's a forecast cash flow shortfall, and then for sponsors and trustees to collaborate around how to remediate this. So to make that concrete, let's take the example of a fully funded scheme holding a significant allocation to credit. Now, under a traditional gilts plus a fixed margin approach, if there's an increase in credit spreads, then all else equal, this would cause a deficit and it would send a signal for deficit recovery contributions. Now, if the increase in credit spreads is driven by a liquidity squeeze rather than an increase in expected or actual defaults, well, arguably that's quite an unhelpful dynamic. Certainly on the part of the sponsor, if they believe that this could lead to unnecessary contributions and then challenges around future surplus extraction. And that dynamic works in the other direction too. In a scenario where there's a flight to safety leading to falling risk asset valuations and tighter credit spreads, well, it's feasible that the reduction in credit spreads could mask a weakening in the position of expected future cash flows under a traditional fixed margin valuation approach. Now, in both scenarios, a dynamic discount rate approach facilitates a shift in focus away from the balance sheet position and a shift in focus towards, well, the underlying sufficiency of asset cash flows to meet benefit payments when they fall due. And in turn, I think this is more closely coupled with the fundamental purpose of a pension scheme, which is to pay members an income in retirement. The second theme I'd like to touch on, which is implied indirectly by the first, is flexibility, particularly around asset allocation. In principle, this framework could maintain a stable funding level when investing in a broader range of cash flow generating contractual assets other than just gilts. Under this approach, trustees have the flexibility to allocate more to this type of asset class, while sidestepping at least in part the disincentive of funding level fluctuations. And as an aside, these potential benefits don't reference the cost of funding the pension scheme, although managing this cost is clearly an incentive on the part of the sponsor in particular. And I think it's worth calling out this particular risk. In a traditional valuation approach, the investment strategy is often tilted towards quite conservative asset classes, given the spread above gilts within the funding basis is modest. In a dynamic discount rate approach, because the valuation methodology is driven off the asset strategy rather than vice versa, well, other channels and controls are needed to limit the investment risk within the strategy to appropriate levels, given the covenant strength of the sponsor. And I think that's a good segue to think about the impact on members. If the DDR approach is underpinned by a risk-managed investment strategy, delivering cash flows to meet benefit payments, well, it can deliver good member outcomes. But even if the reliance on the sponsor should be limited from the perspective of injecting future cash if everything goes well, the continued support of the sponsor from the perspective of underwriting the investment risk is needed. It's needed as a security measure to provide a contingency across the gap between the funding and the solvency bases. And it's important to ensure that the security of member benefits isn't compromised if the scheme chooses to follow this type of approach when running off its liabilities. And an implication of that is that implementing this type of approach within a broader, robust risk management framework is appropriate to ensure that member security isn't inadvertently reduced. And now it's going to be helpful, I think, to look at an example. So in that light, I'm going to pass over to Luke, who's going to discuss how this type of arrangement could be implemented in practice. Thanks, Luke.
Great, thanks, Phil. So as we've just heard, Phil's explained the potential benefits of a dynamic discount rate approach for pension scheme funding. And in this section, we'll now look at how pension schemes might go about implementing this type of approach in practice. So to help inform our thinking, we carried out some modelling for a sample pension scheme. And this modelling led us to a step-by-step framework, which is outlined on the slide. Now, we think this framework is a good starting point for schemes that want to adopt a dynamic discount approach in conjunction with a cash flow matching investment strategy. Now, the key feature of our approach is that it uses a discount rate of gilts plus a variable margin, which is defined in steps 1 and 2, plus a prudence buffer defined in steps 3 to 6. Now, the buffer means that from a funding perspective, the target is to aim for more than 100% funded on this basis. Now, we think the prudence buffer has two main advantages over a more typical scheme funding approach, targeting 100% funding on a gilts plus basis. Firstly, the margins for prudence are considered more explicitly through the derivation of the buffer. And secondly, as Phil mentioned earlier, instead of determining a suitable investment strategy based on a defined gilts plus prudent margin discount rate, this approach instead starts with consideration of the investment strategy. Now, we think this might encourage schemes to invest in a less constrained way, perhaps with greater consideration to higher yielding assets instead of gilts. Now, if we move on to the next slide, we'll look at each of these 6 steps in a bit more detail using a worked example. And for those of you interested, this example is described in quite a lot more detail in chapter 6 of the paper. So starting with step 1. So here, the starting point is the best estimate liability cash flows as calculated by the scheme actuary. Now, using these cash flows, the investment advisor can develop a suitable asset portfolio with a high degree of liability cash flow matching. Now, for our example, and for simplicity, we constructed an asset portfolio consisting mainly of investment-grade corporate bonds. And our optimization process focused on minimizing the difference between the projected annual asset and liability cash flows. Now, setting the liabilities equal to the market value of our portfolio of bonds resulted in a discount rate of gilts plus 1.4%. So moving on to step 2. So the asset cash flows we used in step 1 made no allowance for investment costs. For simplicity, we applied a deduction of 0.2% per annum to allow for investment costs, which we thought was reasonable for a portfolio of corporate bonds based on historical data. So bringing together steps 1 and 2 in our example, this results in an initial discount rate of gilts plus 1.2%. Now, the next steps focus on deriving the funding buffer above the liabilities discounted at gilts plus 1.2. Now, another way of thinking about the buffer is that the calculations in the first 2 steps are on a best estimate basis. The buffer then allows for margins for prudence to be considered explicitly and included in the funding basis. So in steps 3 to 5, we look at asset risks, asset liability mismatch risk, and liability risk separately. Now, in practice, the risks to consider in these steps will depend on the scheme's specifics, particularly the asset portfolio, but also the profile of the liabilities. The framework therefore encourages trustees and their advisors to think carefully about each of the key risks faced by the scheme. Now, turning back to our example model, we considered some sample asset and liability stresses and the impact on the funding level in order to derive the buffer. So if we start with step 3, where we look at asset risks. Now, as our portfolio is mainly corporate bonds, credit default and rating downgrade are the key risks. For ease, we applied the Solvency II calibration for probability of default and the cost of downgrade to the asset portfolio. Now, it's probably worth noting at this point that the Solvency II assumptions are intended to be prudent and may not be appropriate for pension scheme funding purposes. And we do consider alternative approaches for the asset risk buffer within the paper. Now, in step 4, asset liability mismatch risk. So in our example, the buffer, 0.1% of liabilities, might feel a bit low at first glance. This is because our asset portfolio is designed to closely match liability cash flows, meaning that the projected excess or shortfall of asset cash flows at any point in time is relatively small. To illustrate this point, if we kept that same asset portfolio, but instead used liability cash flows, assuming members did not take cash at retirement, the buffer here would increase to 5.5%. So quite a significant increase from changing one liability assumption. Finally, in step 5, we looked at the impact on the funding level under 2 liability stresses. Firstly, that members live longer, and secondly, that members take cash at retirement. Now in step 6, which is the final step, we need to determine the overall buffer, allowing for the expected costs and risks defined in the previous steps. The key consideration for us here is how do we combine the various buffers? Now, we thought it was overly prudent to add the full increase in the buffer for each asset and liability risk assessed, particularly as there was prudence applied when determining these buffers. For the sample modelling, we made some simplifying assumptions for the correlation of the various risks assessed. The main assumption being that the asset and liability risks were uncorrelated. Now, as you can see on the slide, this reduced the buffer from 11.2% of liabilities to 9.5%, so a relative reduction of around 15%. Okay, so if we take a step back, we've briefly run through the steps of our proposed framework to determine both the initial discount rate and the prudence buffer. But how do we see this working in practice? So if we move on to the next slide, Gareth. Thank you. Oh, one back. There you go. So on this slide, once we've agreed the detail of each step based on the scheme specifics, the scheme actuary and investment consultant can work together to consider alternative investment strategies and optimize the funding outcome. Now, we think this has similarities with the optimization process undertaken by both insurers and also pension super funds under their respective regulatory regime. And on the next slide, the final point in relation to the framework. So the framework I've outlined is focused on setting the discount rate and the buffer at the valuation date, so time 0. For ongoing funding monitoring, you can use sensitivity analysis to create a formula for the funding basis that changes with the key parameters. And there's a lot more detail on how you might go about doing this in the paper. So for the final slide in this section, so we've touched on a few of the key modelling issues that you might need to consider under our proposed framework, such as the identification of asset and liability risks when determining the buffer. Now, depending on the scheme specifics, there may well be other points that need to be considered. So just to pick a few examples, firstly, deficit contributions. So in our model, we assumed that the scheme has sufficient assets to fund the initial investment portfolio, and so we did not account for potential future sponsor deficit contributions. Now, if in practice deficit contributions were agreed, it would be relatively straightforward to include these in the model as a series of fixed payments, similar to a short-dated bond. Secondly, our model assumed that the assets are held on a buy and hold basis with no changes to the investment strategy. Now, if in practice there were going to be expected future changes to the investment strategy, allowance could be made for this, for example, by adjusting the initial discount rate, so increasing or lowering the implied yield relative to gilts, or by making an adjustment for this in the prudence buffer. The final point I wanted to touch on, and this is sort of a hot topic in the moment in the pensions world, given the recent improvement in funding levels, is discretionary increases. So our framework is focused on assets which match the expected benefit payments. And this means that there may be less chance of a surplus emerging in future. In turn, this could mean less chance of members receiving discretionary pension increases to the benefits being provided. This will, of course, depend on a number of factors, such as the current funding position of the scheme, and also the willingness of the sponsor to allow discretionary increases where they have the ability to approve these. So that was it on the modelling section. I'll now hand back to Phil to talk you through new skills and next steps.
Great, thanks, Luke. And in the light of that example, I thought it would be worth drawing out what are the skills and knowledge that we within the actuarial profession and then the industry more broadly might want to focus on if we want to implement this type of framework. And before I get into the details of those, I think you could fairly argue that these aren't truly new skills, but just old skills applied in a new way. In any case, there's a much tighter coupling of assets and liabilities under this approach. And I think this means that actuaries, regardless of whether their background is liability side or asset side, should get more comfortable with traversing both sides of the balance sheet. For example, scheme actuaries might want to get closer to understanding some of the details of credit assets, like prepayment risk, and build an intuition around the impact of these factors, the impact these factors would have on the funding position if they crystallize, and why. And investment consultants might need to engage much more directly with, as an example, the investment response to higher than expected transfer values, recognizing that any resultant shifts in asset allocation would have a direct impact on the funding position by design. Coupled with that, we need to not only understand these factors ourselves, but we need to be able to communicate them effectively. And that's essentially an exercise in framing something which is relatively complex in ways that are relatively simple and intuitive, if that's possible, and helping stakeholders understand what's most material and what's less so without getting lost in all of the detail. We want to keep the focus on the underlying philosophy of this type of framework, which is monitoring that our assets are expected to deliver enough future cash flow to pay scheme benefits. Now, the final area I want to touch on is a little different, and it's around data considerations. Under this approach, given the linkages between asset yield and the liability basis, there's a greater reliance on asset data to underpin liability estimates. And from a monitoring perspective, this can introduce delays. So finding pragmatic solutions to develop monitoring frameworks in the context of potentially missing data in order to keep the focus on the primary signal around whether there's sufficient cash flow to meet benefits. Well, that's going to be important if we're going to get best value from this type of approach. And there's lots of other skill sets that we can partner with to do that effectively at scale, like data engineering, data management, and product management perspectives. The evolution of our actuarial skill set to work effectively within multidisciplinary, digitally mature teams is a theme which impacts many other areas well beyond dynamic discount rates. But nonetheless, I think it will be important to inject these perspectives into the design of DDR risk management frameworks. And I think that's a good point to land and look forwards. So let's flick onto the final slide and look at how we can build from here. So we had a series of proposed next steps, and we've separated these into actions for the IFOA, TPR, and scheme actuaries. So for the IFOA in particular, there were three thoughts. As this is a new area for many actuaries and is likely to become more prevalent over time, well, we think that there would be value in looking at the training and guidance available to its members, to actuaries in the following areas. So reviewing curriculum for actuarial exams, considering issuing guidance and information on how cash flow generative assets that are fixed and bond-like in nature, how they actually work and how they can be incorporated into a DDR approach to funding a scheme. We want to help actuaries understand the risks inherent in different types of assets so that they're really well equipped to explain the position clearly to trustees and other stakeholders and provide appropriate advice on how that interacts with the funding assumptions. And we think there's also lots of fruitful further research that could be done in this area. So, for example, things like the correlation between liability side risks, some of the different factors that Luke touched on and called out, they're not independent of one another, and thinking about how can we project and look at and understand those risks better so that we can understand what is an appropriate size of buffer and what does prudence look like. That feels really helpful, particularly around aspects like hedging inflationary increases as schemes become better funded and how we do that appropriately. For TPR, we recommend that if this approach becomes more prevalent, then capturing the information around that on how schemes are implementing DDR approaches would be a really helpful angle of attack. This could be potentially part of the information provided within the new statement of strategy, which trustees will be required to submit to TPR in the future. And for scheme actuaries, this approach relies on the accurate modelling and understanding of benefit cash flows. So as much as we want scheme actuaries to really understand the asset side and the cash flows that are coming from there, keeping focus on really high quality data for the liability side and the benefits that need to get paid is important more broadly than just DDR, but particularly important in this context as well. So I think that's everything that we had to share. I hope some of that's been helpful and interesting. And I think probably it's time to open up for if there's any Q&A to take from that point forward. So Gareth, am I handing back to you to take us maybe through some of that, and we'll take some of the questions from there.
I think it's back to James.
Back to James. Okay.
Yeah. Okay. Great. Thanks, Phil. Yes, we've had a few questions. So first of all, thanks very much for that talk. That was a very interesting and informative talk. We've had a few questions from the audience. So a few I've seen they've been answered live, but maybe it's worth just asking more broadly, because one of them I've seen elsewhere, people making this point. So from John Spain, he's made a point about just discounting in general. So for long-term financial institutions, the discount process itself is the problem. Robust ALM is far more important for all parties. So I think that's just basically a question on whether we should be discounting at all. Hopefully I'm catching that point properly, John. But from the point of view of this working party, what's the main driver for the discounting approach?
Yeah, I had a stab at answering John's question because I know he's asked that question before at other events. So hello, John. Happy, Luke, Phil, Kenny, happy for you to add to or disagree with my response.
Maybe just to chip in a couple of thoughts. So I definitely agree that sort of long-term asset liability modelling and projections are a really helpful tool to interrogate and understand what are some of the underlying sources of risks. And for me, at least, I don't see dynamic discount rates and the sort of discounting using that type of methodology as a standalone piece, right, that would be coming through. I think actually combining a lot of those different avenues and ways of thinking about things is helpful in looking at the same piece through different lenses. I think the piece for me is that making the cash flow, making the discount rate dynamic in this sense and making that more explicitly linked to assets is helpful in thinking about cash flow sufficiency, not as the sole tool. That I think that combining that with projections is definitely helpful. But can we refine the way that we're looking and constructing our funding discount rates so that it's a more explicit signal of are we expecting to get enough cash flow in the future, and to really drill into what's driving that in terms of on the asset side, on the liability side, that is helping to signal those types of elements. Luke, I don't know if there's anything you'd want to add, or Kelly, or others. That's my perspective.
I think that's really helpful. I mean, I think I'm not sure if I fully understood the question. I think John's point is that it's helpful to look at deterministic, and maybe that's helpful, but it's also helpful to look at stochastic processes, and what does that tell you? I think personally, stochastic processes, stochastic ALM are really helpful. I think one of the problems with them is making sure that all the relevant stakeholders understand exactly what's going on and exactly what all the assumptions in there are doing and exactly how it all fits together. So in my view, there's a place for both. And I think, as Gareth mentioned, we weren't in our paper sort of saying you have to do this in the deterministic way. We just did it that way because it was an easier, to be frank, way to set up a sample model.
Okay. Great. Okay. Thanks for that. One question I had was on the timing of when this might be used in practice. Is there an idea? Is there an idea of when that might actually happen?
Shall I go first? Well, in terms of timing, do you mean in terms of the scheme's lifespan or size of scheme or driven by legislation?
When we might actually be using this dynamic discount rate approach in practice?
Well, I think it really is. I mean, I wouldn't like to be. The way I'd look at this is the regulator thinks it's a good idea, or it could fit nicely with for mature schemes under the new regime. But I'd regard it as just a good idea, and the legislation's catching up with that good idea. I think if you've got a very mature scheme and a well-funded scheme, the last thing you want is a lot of funding volatility caused because the discount rate hasn't been set in it has been set in a simplistic manner. So if you've got a scheme that you think is, virtually perfectly cash flow matched, you're not expecting funding volatility because the discount rate doesn't work properly. You're expecting funding volatility because there's been experience items such as people living longer, not commuting as much, whatever it is. So I see it as being more, you could use it now. It works best for a scheme that's mature or a scheme where the cash flows, asset and liability cash flows match each other very well. But it's more, I'd see it as more, the phrase endgame planning is used quite a lot. I see it as more something that could be built into that sort of thinking that ultimately that's where you want to get to. I mean, you're not going to get there overnight, but you should start planning for that. And you may introduce elements of the discount rate that are dynamic in nature, where you've got a particular subset of assets and liabilities that do move well together. Well, treat those in a dynamic manner. And then the rest, as they start to get there and become more mature and easier to match, then you're going to have more and more assets and liabilities in the dynamic discount rate category of the scheme. So I see it as being something that can evolve. One thing I would note when I mentioned size of scheme, I think you do get to a natural breaking point for this sort of modelling for very small schemes, not because they couldn't do it from an asset side, it's just more the uncertainty in the cash flows. So I think that's size does matter in that sense, not from we're not saying small schemes couldn't do it. It's just more, it's going to become less and less useful because you're trying to match cash flows, and small schemes have more idiosyncratic risk in those cash flows.
Okay, so if you had some non-fixed cash flow assets like property or equity, say, you could kind of hive those off and use this approach for just the fixed cash flow assets.
Welcome comments from the other speakers, but yes, I think that's the thing with this. There's the paper itself. If you look at the example we've done, it's quite an extreme example given because we have very good matching between the assets and liabilities. We recognise in practice that is unlikely, either because we don't have the assets to cover all those liabilities perfectly, there aren't the assets available, or the scheme wants to hold growth assets. So I see it as more, we've got the purist version in the paper. If you work backwards from that, yes, you could have some element of dynamic discount rate approach, but it's more just recognising that simply because the scheme isn't there doesn't mean it's not a useful method. So you could have an example with growth assets in there. Then you need to have a think about how you're going to set the discount rate for those growth assets. But you just need to recognise that they do not perfectly match the liability cash flows.
Okay. So another question was what proportion of schemes does the Working Party think the DDR approach could be relevant for?
Any thoughts, Luke, Phil, Kenny?
Maybe I'm first good. I think it's hard to say, but I probably agree with Gareth that it feels like it's more likely to be used by larger schemes, and probably those schemes that may be looking to run on. The other point maybe worth mentioning, James, which comes back to your earlier question, is in the pension super fund world, we currently have a fixed margin above gilt, which is subject to review depending on how market conditions change. Now, the government have highlighted that the direction of travel for super fund legislation, which is of particular interest to me, is for there to be a dynamic discount rate. So that, you know, is the direction of travel. It's something that I'm personally supportive of, but there's obviously a lot of work to do to get to that point, so that we've got a dynamic discount rate for super funds. So that would be another use, I suppose, that's coming down the track. But I think Gareth's right that, you know, smaller schemes, given the sort of idiosyncratic risks, may be less likely to be as useful. And obviously schemes that are sort of targeting insurance in the not too distant future or other consolidation solutions may be less useful there too.
I'd say that question, it's one of those ones, if you'd asked me before, when the paper was first drafted, when we first established the working party early 2022, I had one answer. Then the answer changed when we went through September 2022 because schemes are a lot better funded. And now we've got the Mansion House reforms being proposed. My answer has changed again. So gut feel would be very large schemes. So by number of schemes, I suspect it'll be a small number. By size of liability or proportion of overall liability, my guess could be, you know, 10, 20% of schemes who want to run off and are of particularly at the larger end, they may want to look at this approach or a variation of it.
Okay. So, but in principle, if you do this approach, it has a real benefit of stabilizing the surplus. So there's a kind of a driver for as many schemes as possible. Even if you were a small one, there would be a benefit for doing this.
Personal view here is I think if at the smaller end, the chances are that those schemes are probably, the end game that they will look at is probably just securing benefits with an insurer rather than a run-off strategy. I just think it's simpler and schemes are far better funded now than when we established this working party. It's more schemes wanting to commit to the governance of this and being of a sufficient size where this is worthwhile. So I think even if you'd argue in theory it could work at the smaller end, putting aside the argument about you know, uncertainty of cash flows, I think in practice there's a practical element, which is the smaller schemes are likely, if they are so well funded, to just buy the benefits out.
Okay. There was a question here from Chris Squirrel, which I think is coming back to this idea of whether or not we should be discounting. But the question is, if the question is what assets do we need? What do they cost? Why is it helpful to convert this into a discount rate? Is this for the clients or for the actuaries?
Okay. Anyone want to have a guess at that, or shall I have an attempt at an answer? I think if you look at the modelling that's actually been done in the paper, and I think this touches on John's question as well about cash flows, this although we have to boil things down to a discount rate because that's what the regime requires, a lot of the work done on this dynamic discount rate approach is visual. So we are comparing cash flows from assets and liabilities and detecting when cash flows don't match up. So I think my response to this would be, well, we need, the legislation requires us to boil this down to a discount rate. So that's about all we can say on that, really. We do need one, but if you look at the paper, it is quite visual, the analysis that we've done, and it does help clients identify these things about, you know, cash flow issues in terms of asset cash flows and liability cash flows not occurring at the right time. And that's one of the penalties. If you look back at Luke's slides, one of the penalties in the buffer is if the assets and liabilities don't match up well, then you need a bigger reserve.
Yeah, that was one question I had on that. So you have a kind of penalty function for mismatches in the discount rate calculation. Can I ask what that was based on, that sort of penalty for mismatches?
Luke, is that one for you? Close to the modelling?
Yeah, sorry. Yeah, James. So essentially, at each annual time step, we looked at whether we had excess assets or a shortfall of assets, and when we had a shortfall, we assumed that you'd need to sort of fund that at a gilts cost. I suppose another way of thinking about that is almost like the sponsor would lend the scheme some money to fill that shortfall, and we sort of assume that there'd be sort of an interest rate of gilts applied to that. And similarly, where we had excess asset cash flows, which is, of course, you could assume are being reinvested, we assume that that would sort of return in line with gilts as well going forward.
Okay. Okay, and there were no other sort of cash flow, because it sounds quite like you mentioned the matching adjustment style. It sounds overall quite similar, except I mean the matching adjustment doesn't have that sort of penalty function, but does have some separate PRA tests.
Yeah, no, and I think, James, actually, I think I went to your presentation on matching adjustment about 4 years ago, which was really helpful. And I think there are some similarities. But I think my overarching view, and maybe Kenny's better to comment here, is I think the matching adjustment is a bit more prescriptive than maybe sort of what we did. Is that fair, Kenny?
Yeah, that's what I was going to add. The matching adjustment puts a lot more clearer boundaries around what is allowed through the originally 3, now 5 tests of the PRA, and even going as far as obviously to prescribe the fundamental spread, i.e. the allowance for defaults and downgrades, which Luke was referring to briefly as well.
Okay, great. So another question was, is there a minimum scheme size for the DDR approach to work or to be relevant?
I think going back to the earlier comments, it's difficult to say exactly where that line is drawn. It's once there's two things. One, once the client doesn't want to, I mean, there is initial governance setup costs here in terms of developing the framework, but it's more the breakdown of the cash flows when you're not able to say those the future cash flows on the liability side are known with much certainty. So I would probably say, gut guess would be schemes below 50 million, and that's just pulling a number out of, I won't say out of thin air, but based on clients I've worked with, I doubt a scheme below that size would want to look at this sort of approach.
I guess there's one other aspect as well, Gareth, right, in terms of, so one is the governance bandwidth of the trustees and who's actually running that, and because there's quite a lot of detail in making these decisions as part of that construction process of, you know, what are the different risks we're going to be looking at, how do we measure them, how does that impact our construction process and monitoring that over time. But there's also then the what is investable, what are the asset classes that you can invest in, and some of those, certainly a liquid contractual cash flow type assets, you need to be of a certain scale to effectively access them, that will be coming through. And if actually one of the benefits of a DDR approach versus a fixed gilt plus a fixed margin approach is that it enables you to integrate those types of assets into your investment strategy in a way that doesn't drive funding volatility. Well, if actually you can't access those investments for other reasons because of scale, then maybe actually some of the benefits from that particular narrow angle fall away somewhat. So yeah, I think the ability to run it effectively and to sort of monitor and manage that over time, and also what's the opportunity set of what you could invest in, are probably the effective constraints of, is there a good prize there for why you'd want to go to the effort of implementing this in a particular case.
Okay. We had another question from John Spain asking about the best estimate calculation. So presumably that's just the discounted cash flows and at this rate, the dynamic discount rate. So
I think, James, our starting point there is really the actual cash flows rather than the sort of discounted value. And in terms of the sort of best estimate cash flows, I suppose there's different ways to define best estimate. One way might be to say, well, there's a 50% chance the cash flows would be higher and 50% chance it'd be lower. I think we sort of just took the view, I mean, we used a sample scheme based on some sort of assumptions. I think there's sort of a well-trodden path, though, here in the insurance world in terms of determining a BEL, which is obviously based on some best estimate assumptions around mortality, etc. I don't think we were trying to give a view in this paper on how, you know, what is best estimate. Everyone's going to have a slightly different view of that, but that was a sort of starting point there. I don't know, Gareth, so if you want to add anything.
No. I think just on that theme of best estimate, the one key difference with the approach we're taking in this paper is we are expressing the funding basis as discount rate, which is close to the best estimate. The difference being that we've knocked off a bit for investment expenses because that seemed the best place to do it. But then we've got a funding buffer. So the way the basis will be expressed is the trustee may be aiming to be 110% funded on a gilts plus whatever basis it is, and I choose gilts as a proxy for some sort of measure that we can monitor over time. But the point is, it's not 100%; it's 110 or it's 100 plus something. Whereas typical funding bases, you aim for 100% of something. So we see that as being different in that the buffer is specifically identified. There's analysis carried out at the valuation date to identify what goes into that buffer, and to me it's a more explicit way and a more understandable way for trustees to focus on, right, what do we think our liabilities are? So what is that best estimate, and what's the margin we need on top of that, because things might go wrong. So that to me is one of the main elements of the approach, or what we've regarded as the dynamic discount rate, that it does look at the way it expresses the funding basis. It is slightly different, but gives more information in my view by doing it that way.
I think one final point to add to that is that there's both the underlying structure of the benefit side in terms of what the promise is that we've made to members of the scheme, and making sure that is best estimate, and thinking about what's the variability there, but also maybe a bit more focus on the asset side itself. So actually the thought process of, for a particular type of credit, what's the haircut that you'd want to allow for, given the best estimate defaults potentially that come off that, given the credit rating of the scheme, and then what's the further reserve or buffer that you'd want to allow for that's reflected in the remainder of the credit spread. The way you land there, I think, can be different and depend on your particular views on the asset classes, but the thought process of splitting that out and thinking about those two things separately, I think is quite a helpful one, rather than wrapping that all into a prudent discount rate, where actually then the prudence and the best estimate path of what you think is likely to happen and all gets wrapped up in one. Thinking about those things independently is, I think, puts a bit more colour on sort of how you're funding your scheme over time, to my mind.
Okay. Great. Another question was, would there be any requirements to hold assets to maturity, as we're sort of taking benefit for the liquidity premium part? So do you have to kind of hold them without sale, or?
Are you going to come in on that, Phil?
That feels consistent to me with the. So if the logic is you're looking actually at the underlying cash flows and you're trying to allow for the credit spread as that varies over time, then if you're also planning to do that in the context of selling your credit in a year's time, well, that's going to crystallize whatever the price is that's prevailing at that point. So it feels more consistent for me to be saying, well, actually, we're just buying a series of cash flows in the market, which are contractual and high quality, and we're going to use those cash flows to fund benefits as they fall due. Now, I don't know whether it's quite as simple as that, because then as you're on that path, there's often opportunities to swap out, a series of cash flows with a better series of cash flows, given the credit rating and the like. So I don't think it's quite as constrained as you buy, a series of asset class and then forget about it forevermore, because you want to maintain the credit quality and make sure that there's not a deterioration over time. But the idea of sort of running off the assets over that period of time in the context of this sort of overarching strategy feels more consistent than, say, aiming for a constant maturity allocation where you're rolling some of these types of underlying assets over time, because the latter will be locking in the credit spread as that fluctuates to a degree. Luke, Kenny, I don't know if there's anything you'd want to add to that, or?
Yeah, we'll certainly buy and hold, and buy and maintain, be more consistent with the principles we see in sort of Solvency UK, Solvency II matching adjustment, and kind of, echoes the same sort of points you're making there, Phil, about how you recognise the spread, because really that spread is a long-term spread.
Okay, great. I think we've got time for just one more question. If the DDR approach becomes more prevalent, on average, does the working party envisage this approach giving rise to stronger or weaker funding bases?
Shall I go first? As the schematry on the panel. Honest answer is I don't know. I think if you think about the way the regime works at the moment, if you make any changes from your existing statement of funding principles, it's got to be on legal, economic, and demographic reasons. I'd be surprised if trustees agreed weaker bases, much weaker bases, as a result of this new framework. I'd also be surprised if they agreed much stronger bases. I think it's more just a different way of looking at the reserve held, probably more focus on the assets that are held and how they tie up with how they marry up with the liabilities. So I don't think there's any. I can't see it go materially much stronger or much weaker. I see it as just a different way of presenting the information and a better way.
Because it would seem kind of logical to me that you might transfer across on a sort of neutral basis, and then go on from there, but under a more sort of clear, more sort of explicit approach that we're discussing here.
The one time I could see the basis being weaker, if you look back at that analysis, I know this hindsight's a wonderful thing, but if you look at the analysis on that chart on one of the, I think it was page 1 or 2, where we had the funding levels vary around the time of the credit crunch. With the benefit of hindsight, an approach such as the dynamic discount rate at that time may have given higher discount rates than were actually used in practice. But that was because they would have moved more in line with the credit spreads. So I'm not saying they'd moved completely in lockstep with the increase in credit spreads at that point, but they'd moved a little, but they probably moved a little more than it was in practice. So at that point, relative to some sort of gilts plus fixed margin, I suspect the basis might have been a bit weaker. But in normal conditions, I expect I wouldn't see the bases as being massively different. It's just an easier, more intuitive way of expressing the discount rate.
Okay, that's great. I think we're at time there. Just to say many thanks to Gareth, Luke, Kenny, and Phil for a great presentation and question and answer session. We'll be back next month with another event on Knocker. If you have any questions for the Dynamic Discount Rate Working Party, I think you guys are on the Institution of Actuaries website. You have a page there. But yeah, please get in contact with them or email us and we'll be sure to forward you on to them. But with that, just to say thank you and goodbye.